Hello everyone, I hope you guys are doing well and your studies are going in full swing. Now today's video we are going to discuss about the financial reporting RTP of May 26 and something that has created a lot of chaos and fear among a lot of students. The initial 13 pages of these RTPs which have a set of amendments. Now we'll discuss in this video all these amendments. There are 13 pages. We have tried to summarize this into very two clean charts. So I'll share these charts on the Telegram channel as well. The link for this in the description. So you can take that. This is completely exhaustive from an exam perspective. And then all the different questions which are there in this RTP, we will even discuss that. So I've just mentioned the questions which are slightly different. Though you don't have completely off the track questions, you do have questions which are slightly different in terms of concept application. We'll discuss all of these. Okay, so let us get started. Now, first of all, when you look at these amendments have come in 4 standards: Ind AS 1, Ind AS 12, Ind AS 7 and Ind AS 21. So these are the 4 standards where the amendments have come. And these amendments were notified through circulars in, let us say, I think May as well as August 2025. So are these applicable to your May 26 exams? Yes. In terms of importance, are they going to change all that you have studied? In my opinion, nothing changes. Most of these are additional things that you should be aware of. From an exam perspective, if something is relevant, that is only for Ind AS 1. And again, for Ind AS 1, there is a slightly interesting amendment for which we have put a separate video as well. I'll just link it up earlier. I'll just discuss that again in any case. So there's a different treatment if you're writing, let's say, the May 26 or September 26 paper, and there's a different treatment if you're writing, let us say, a later paper, let's say May 27 and onwards. So we will discuss each of these items and let us get started. So over here, the first amendment per se, I mean in terms of how they have given, is on Ind AS 21. So I'll just kind of mark it as well so that you can jump up to the amendment which you think is relevant. This was in the notification that was issued in May of 2025. All of these are amendments to bring your standards Ind AS in line with what is there in international accounting standards. So in terms of importance, as we have mentioned, Ind AS 1 amendment is the most important. Other amendments we will just have an overall understanding from an exam perspective and then see how to take this forward. So when you look at this amendment, they say that what happens if in a particular currency there's a lack of exchangeability. Now, what do you mean by lack of exchangeability, or what do you mean by exchangeability? Exchangeability means if you are having a foreign currency transaction, you need to convert, let us say, your currency to the foreign currency or vice versa. If you're an exporter, then the foreign currency to your currency, for which that foreign currency has to be exchangeable. Now, we would, as a student, say, what is a big deal? We can take the foreign currency to the bank and get it exchanged. Well, usually it does happen. However, in a lot of places, this creates a bit of a difficulty. Like, for example, you look at Zimbabwe, there is a hyperinflation. In Venezuela, there's a hyperinflation, in which case these currencies lack exchangeability. Most of the bankers, dealers are not prepared to keep a stock of these currencies. And as a result, for you to exchange these currencies becomes very difficult. This even happened during the geopolitical conflict that was there between Russia and Ukraine, where people were not ready to accept the Russian ruble, or in today's environment, the Iranian rial. So in that context, IFRS or Ind AS came up with a separate guidance that what will happen if your currency lacks exchangeability, because Ind AS 21 entirely is based on the fact that you will record the transaction based on the exchange rate prevailing on the date of the transaction. So usually that exchange rate prevailing on the date of the transaction is given. Now, given meaning you must have taken it, let's say, from a bank which is kind of an active market for doing transactions in that currency. However, if your foreign transaction is in a particular currency which lacks exchangeability, lacking exchangeability again means that you are not able to exchange that currency into your own currency or your currency into that foreign currency. Let us say we take the example of the Zimbabwe currency. You're not able to exchange into the Zimbabwe currency or vice versa within a normal time frame. In, let us say, an observable market, you are not able to do that. In such a case situation, how will you find the spot rate as on the date of the transaction? So there is some guidance which is given for this very rarest of the rare case. First of all, this is very rare, so as you see, that is for a very, very specific and unique case, but nevertheless, if it comes, you should be aware. It is based on a general guidance. It does not impact anything at all that you have studied. No question, nothing gets altered. So how do you figure out what are the factors which will determine whether the currency that you're talking about is exchangeable or not? Like, you will in the first instant assess if the currency is exchangeable. Most of the questions that you have done pertain to currencies like the dollar, euro, pound, yen. All of these are highly liquid and exchangeable currencies, and hence you don't need to bother. But if there are other currencies, like for example, you're doing a currency with the Argentinian peso. Now, Argentinian peso, if you go to an Indian dealer, they will not have a stock of Argentinian peso, or if you need, they will not have the stock, and hence one might jump to a conclusion that this is not exchangeable, which is incorrect. Remember, there may not be a direct transaction between the Indian rupee and the Argentinian peso. However, when you do AFM, foreign exchange, you have a concept of cross code. That is, you can convert, for example, the rupee into the dollar and then the dollar into the Argentinian peso, and boom, that's it. You can get access to the Argentinian currency, in which case we will say that the currency is exchangeable. Sir, but I don't have a direct code. That is fine. Ind AS 21 acknowledges, accepts, and says that your spot rate can be the rate coming out of a direct code or even an indirect, for example, a cross code. That is absolutely fine. The Argentinian currency, in such a case, if let's say there is an active market from the rupee to the dollar and then the dollar to the Argentinian peso, it is very much exchangeable. However, in case we want to move into the Iranian rial or the Russian ruble, for example, it can become a little difficult, especially in light with the conflicts that is happening these days, and hence there may be some questions on exchangeability. So what are the factors that you need to consider? First of all, are you able to get your desired foreign currency within a normal time frame? Normal time frame is typically 1 or 2 days. However, if it is taking you 6 months to arrange that, it is not considered to be an exchangeable currency, because in a spot transaction, usually the currency can be arranged in a very short span of time. So first, to assess exchangeability, you will see that how much time does it normally take to get that currency. Second, do you have the ability to obtain that currency? Now, you might say that I don't have any intention. Why should I currently look at, let us say, or there is a loan in Russian ruble. You don't have to repay this loan currently. So you will say that, okay, Russia is fighting a war currently. Maybe my loan is 10 years. After 10 years, there's no problem. I think the war would have been done. Putin might not be there, whatever it is. In which case, over here, we might say that after 10 years there will not be a problem. There's a problem now. Well, we are not looking at your intention or your desire on when do you want the currency. We are saying that if you had to arrange the currency today, do you have the ability to arrange the Russian ruble today? If yes, then the currency is exchangeable. If no, it is not exchangeable. Third, is there a market or an exchange mechanism through which you are able to get it? Now, you might always say that there is a black market, and in the black market from somewhere you are able to arrange that ruble. Now, that is not kind of a legally enforceable market. So when they say market or exchange mechanism, there should be a mechanism which is legally enforceable. You might kind of have illegal markets where you are getting, but that cannot be for the purpose of determining exchangeability considered. We will say that are there enforceable legal markets where we can get access to that currency. If yes, it is exchangeable. If no, it is not exchangeable. The purpose for which, see, sometimes what might happen is your currency may be available, may be accessible for a particular purpose, but it may not be accessible for a particular purpose. Like the classic example over here would be, let us say, the difference between a current account and a capital account transaction. Your banks might be ready to give you currency for a current account transaction, but not, let us say, they are not permitted by the RBI to give you that currency for a capital account transaction. So we also need to see that for our purpose, let's say, which is a capital account transaction, like let's say taking a loan, repayment of a loan, is the currency available? It may be available for other purposes, but is it exchangeable for my purpose? That is what I have to look at. And lastly, the ability to arrange sometimes only a limited amount. So let us say you need to repay a loan for which you need, let us say, 1 lakh units of the currency. You can barely arrange for 1,000 units of the currency. Like, remember when there was demonetization, there was, let us say, limit on the amount that you can withdraw. Now, as against the amount that you have to pay, you can arrange for a very insignificant amount because the regulators are allowing you a very small limit. In which case, we would say that if that amount is insignificant, our currency is not exchangeable. So for exchangeability, these are fact based assessments. You will have to see the time frame it is needed to arrange that currency, whether do you have the ability to arrange that currency, whether that is currency is coming from a market or an exchange mechanism, whether it is available for the purpose that you desire, and even if it is available, if you are just able to arrange a very limited amount, the currency still lacks exchangeability. So step number one is, when you see any practical case, you will see whether the currency is exchangeable. 99 out of 100 cases the currencies would be exchangeable. And if an exam question comes, unless it tells you all of this, we will always implicitly assume that it is exchangeable and solve in the usual manner. However, if, let us say, considering these 5 factors, your currency is not exchangeable, then you go into the next set of evaluations where you will say that, okay, if it is not exchangeable, then what do I do? Okay, if it was exchangeable, then I will usually apply the principles of Ind AS 21. That is, I will take the spot rate as on the date of the transaction from the market, and that's about it. I don't have to worry. However, if it is not exchangeable, then I'll have to estimate the spot rate. Now, how do I estimate the spot rate? Now, a student might say, now this is a little important if you kind of correlated with what you have studied in your AFM. A student might say that, okay, I will use the parity theories, like the interest rate or the inflation rate parity theories, F divided by S, into those theories which are there to determine the spot rate. Remember, that is not from an observable data. Like you have studied Ind AS 113, it places a lot of emphasis on what you call as observable price, and if observable price is not available, then you go to some derived prices from the formula. So if I have to estimate the spot rate, I will say the spot rate, if the currencies are exchangeable, I will directly do it the way Ind AS 21 suggests, that is, the spot rate would be the available rate from reliable sources. However, if it is not exchangeable, in which case Ind AS says the first preference will be trying to find a comparable observable spot rate. Now you might say that, why? I mean, if it is not exchangeable, then what is the point of this observable spot rate? Now, sometimes what might happen is there would be different sources in an economy, because let's say there is a lot of let us say, I would say, illiquidity in a particular foreign currency. There may be different sources which may be quoting the currency at different rates. So observable spot rate without adjustment, if that is available, you will take that. Sir, but we are not able to make sense. If an observable rate is available, then how is the currency not exchangeable? Well, it is very much possible that you need, listen to this carefully, you need money to repay a loan, or you need money to give a loan. That is a capital account transaction for which RBI is not ready to release money to you. Banks have been prohibited to give money to entities who are taking let us say the Russian ruble to repay a loan, or let us say to give a loan. However, for settling trading transactions, like for example purchase of goods, sale of goods, then subject to certain limits, let us say currencies can be released. So now, for my purpose, I am unable to arrange the Russian ruble. So for me, the Russian ruble is not exchangeable. However, for some other purpose, the Russian ruble is available, in which case I will take that observable rate and take it as a proxy for my working. So over here, there may be situations where there are several rates, or they are available for different purpose, etc. So if my scenario is such that I am getting some other observable rate, even if it is not for my set purpose, for the purpose of foreign exchange workings, Ind AS 21, at least I will show that rate. Point number 1. But what if there is no observable rate? I mean, I could have taken this observable rate without adjustments. It may not be for my purpose, but so be it, I can take it. But if there is no observable rate as well, then I will look at some other comparable rates. Even if I have to make certain adjustments, I will do those adjustments and then take those rates. That may not be the best rates. In fact, the standard tells you, like, I don't know whether you invest in IPOs or not, there's a grey market that is there in IPOs. In a similar way, over here, there can be, let us say, a black market in which these currencies, now they are not legally enforceable. The standard very clearly tells you that if you have to assess, we have to look at rates coming from a market mechanism. But if, let us say, there is no market mechanism and I want to come to a rate, rather than using formulas like IRP or something which is basically based on level 3 categories, I will try to take observable price, even if it is coming from, let us say, a market where you cannot have enforceable terms. That is, it may be a black or a grey market as a case. Maybe even that is permitted, subjected to certain adjustments like adjustments for liquidity, etc. You might do it and then arrive at the price. So the second preference over here is the observable rate plus or minus adjustments. And that's about it. So as you can see over here, this is a fairly big amendment. If you go to see in your RTP, it takes out of the 13, it takes around let's say 5 or 6 sides, and when you read it appears to be very, very heavy. However, this is a general summary. If I have to do, this will be applicable for transactions where, let us say, there are currency units which may not be exchangeable, in which case you first assess whether the currency is exchangeable or not. If it is, then standard regular working of Ind AS 21 will apply. If it is not, then you will try to estimate a spot rate which can be based on observable price of, let us say, the currency without any adjustments preferably, and if that is not available, then observable price plus or minus certain adjustments as a case may be. Now if there is a situation like this, there are a lot of disclosures that need to be given in the notes. Now for all of this, I would say from your core financial reporting paper, all of these disclosures are very, very unlikely to come in the main exams, though we will discuss this. But in an IBS paper, I would strongly recommend that you keep this RTP with you. You keep the printout of this RTP with you, because it's a relative amendment, it's an open book question, and hence they can ask you regarding disclosures for these items in the IBS paper. So keep that handy. So you don't have to remember a lot of things, but you should be aware of that. So over here, the disclosures would be, you'll have to mention which currency there is a issue, like the Iranian rial or the Russian ruble. What are the restrictions which are there? Maybe the capital account, current account. What are the affected transactions? Maybe the repayment of loan is getting affected over here, that you need to disclose. The carrying value of the assets and liabilities which are getting affected. If, let us say, you had to estimate a spot rate, what methods or markets did you use for the purpose of estimation of spot rate? And lastly, if, let's say, there was a foreign operation, let us say you have foreign operation in Venezuela, or let us say a Ukraine or Iran, apne dhund ke you have put foreign operations. If you had an operation over here, you had to translate these balances. So these balances will also be translated using similar principles. You'll have to estimate the spot rate, and hence you'll have to give a disclosure regarding the foreign operation which is there in these countries, and that is about it. So this is pertaining to Ind AS 21. Now then there is for Ind AS 1, which I would say is the most important, for which on the next page we have prepared a separate chart, because that has a lot of workings. And then there are two small, very, very, I would say, relatively insignificant amendments for Ind AS 7 and Ind AS 12. So first we'll finish off Ind AS 1. Now Ind AS 1 has 3 or 4 items. Most of the amendments over here pertain to the current and non-current classification. Now typically, if you go to see, current classification is those assets or liabilities which are due within 12 months or operating cycle, as a case maybe we take 12 months, and beyond that are called as non-current. Now there is a principle, there is a very important adjustment, if you remember, in terms of loans where there were covenants or conditions. We kind of say, listen to, I'm just recapping what you would have studied. If, let us say, there is a loan that was that had, let us say, a condition like a debt to equity ratio of 2:1 to be met at every 31st December. So that's an important condition. However, in one of the years, your debt to equity ratio shoots up, it becomes 3:1, which means you have violated one of the conditions. So there is a breach of a material condition of a loan. Sir, what happens if it is a breach? So be it. Well, these loans will become repayable on demand. Now they may be a 10-year loan, but if one of those material conditions are breached, these will become repayable on demand, which means if the lender demands, a borrower has to pay, in which case these loans will be actually classified as a current liability. Earlier there would be non-current because the payment is after 10 years. However, if there's a breach of a material condition, the lender can demand money, in which case we will show this as a current liability. So as per Ind AS 1, if there's a breach of a loan covenant, loan becomes repayable on demand. That is a non-current liability, will be shown into current liability. I'll just link this to a video that we have already discussed earlier as well, but nevertheless we'll discuss it again. It's the same thing. But what happens is, a lot of times you can go and you can renegotiate with the banker, you can plead to them, and you can seek a waiver. You can say that, give us a warning, we will not do this again, please give us a waiver. So let us say the banker agrees to give you a waiver. It is not that the loan is waived off, it is that the immediate repayment which the banker could have demanded is waived off, and hence the loan which was repayable on demand will now not be repayable on demand. It will again be repayable, let us say, after those 9 or 10 years, in which case if there is a waiver of the breach which is obtained, that is immediate repayment right is waived off by the lender. If the waiver is obtained, then the loan will again ideally be reclassified back to non-current liability. But all of this depends on when the waiver is obtained. So let us say your breach happened on 31st of December 2025. The waiver was obtained on 28th of February 2026. That is before the balance sheet date, which means before the balance sheet date, I can very well say that there was a breach, so loan became a current liability, but then there was a waiver as well, and hence you can show this back as a non-current liability. Sorry, this is a non-current liability. So if let us say there is a breach and a waiver which is before the balance sheet date, as on the balance sheet date you have no obligation to repay on demand, and hence it is a non-current liability. Now the problem over here arises, and what is the amendment we have written in blue over here? The problem over here arises that what if the waiver comes during the post balance sheet period? Now this is where they have given you two different ways to account depending on which year you are solving. So the amendment actually comes into effect for the year 26-27. So most of the students who are writing the May exams, or even who are going to write the September exams, will be solving for the year 25-26, and hence this change is not applicable to you, as we have discussed in an earlier video as well. So over here we are trying to say that, well, if the amendment is during the post balance sheet period, that is, let us say you had a breach which was happening on 31st of December, a waiver which you got on 30th of April, and the director signed the accounts on 31st of May. So this is a waiver obtained in the post balance sheet period. As per the existing provisions which remain unchanged for the May as well as September 26 papers, you will show this as a non-current liability. This was one of the exceptions which was on the non-adjusting events, where we said that no, even if the waiver is obtained in the post balance sheet period, we will adjust and we will say that let us show this loan as a non-current liability only. So over here, just a second, I think I have just written this a little off. So over here this will be as a non-current liability, and over here this will be, let us say, a current liability. So in the year 25-26, we will say that the event is adjusting, and as a result, if the waiver is obtained in the post balance sheet period, we will adjust and we will say that even though the loan was repayable on demand on the balance sheet date, we will adjust and say since the waiver is obtained, we will show this as a non-current liability. However, if you are looking at the year 26-27, and some students may fast forward right now, they will say that our exam is May or September exam, which is fine. However, if your MCQ comes, you don't know what the institute can do. If your MCQ comes for the year 26-27, you have to be a little careful. Usually I don't think that will come, but if it does come, you should be aware that if this is for the year 26-27, that is starting 1st April 26 onwards, for the year 26-27, if let us say there was a breach on 31st December 2026, a waiver was obtained on 30th April 2027, which is within the post balance sheet period, then to bring it in line with IFRS, we are saying that we will not adjust and show it as a non-current liability. On 31st March, the loan was repayable on demand. It will continue to be shown as repayable on demand, and hence this will be a current liability. So this is the amendment. Other than this, there was no other change. So this would be applicable from May 27 onwards, but if they ask you in an MCQ, please be careful to see which year they are asking for and accordingly solve. As of now, if you are giving the May 26 paper or the September 26 paper, in my opinion, there will be zero changes. What you have studied remains exactly the same. Your solutions do not change. If you are giving the May 27 onwards papers, in which case there will be kind of a change in case the waiver is obtained during the post balance sheet period. Okay, and lastly, if the waiver is obtained after the post balance sheet period, then on the balance sheet date, I think this would be shown as a current liability only. So this will be your final thing. This will be shown as a current liability only. So if it is within the post balance sheet period, there will be an amendment. If it is after the post balance sheet date, then on the balance sheet date, loan is repayable on demand. It is a current liability. There is no waiver, and hence it will be taken as a current liability no matter which exam you are giving. Okay, so this is pertaining to, let us say, the amendment which is there. And then you have an Ind AS 1. There are 3 other cases in Ind AS 1. Now, I would say they are relatively less important. Most of them are clarificatory in nature rather than changing in nature. Like, for example, when you look at a current liability is defined usually as a liability where you cannot defer the payment beyond 12 months. You cannot defer it. Acha, if you can defer it beyond 12 months, it is usually a non-current liability. Now, as per the strict legal definition, it was defined as a current liability is defined, non-current is actually the other way around, but it was said that if you have the unconditional right to defer beyond 12 months, then it will be non-current. Now, what they have done is they've just removed the word unconditional. That's about it. You don't even need to bother about it because all of those specific words did not really matter. Now they are saying in substance. Now the deferral right should have substance, need not be unconditional. Earlier you were following the legal form saying that, okay, if you can unconditionally, no conditions attached, if you can unconditionally, you have the right to push it beyond 12 months. If you want, you can push it beyond 12 months. Then you can say is non-current, otherwise it will be current. Now they've removed the words unconditional and said that in substance, you should have rights which allow you to defer beyond 12 months. If there are such rights, even if there are certain conditions which are there, if you are likely to fulfill those conditions, you can still show this as a non-current liability. Not really important. I would say you can consider the working as you were doing earlier. Secondly, if there are loan with covenants, sir, we studied that these are loan with covenants where there is no breach. Earlier, this entire clause we studied, there was a breach. If there was loan with certain conditions, now till the balance sheet date, there is no breach in the conditions, in which case the classification will continue the usual manner. If the payment is after 10 years, it's a non-current liability. Sir, but in the later years, there are certain conditions. I'm afraid I will breach those conditions. They just clarify and then they say that your classification will be based on the compliance or violation of, let us say, these covenants up to the balance sheet date. Any changes beyond that, we don't have to consider. So we are just clarifying and saying, even this was the same provision earlier. The current and non-current classification will be based on the compliance or violation of the covenants up to the balance sheet date. If, let us say, there was a covenant or a condition that your debt to equity should not cross 2:1, but the condition date was 30th June. Now you are on 31st March. You are scared that by 30th June you will not be able to meet this criteria. So be it. Till 30th June you cannot reclassify it. Your reclassification will happen on 30th June, and hence you are on your balance sheet date 31st March. Your classification will be based on the compliance or violation of the covenants up to the balance sheet date. Now the additional disclosure that has been added over here is if let us say there are some covenants which are coming in the future years, you will have to give a disclosure if you kind of believe that there is some difficulty in you being able to fulfill those covenants. Like if there are future covenants, we are saying future covenants do not affect classification, but a disclosure is needed in terms of what are these covenants, what is the impact that these covenants will have, etc. Okay, so that's about it. I would not say that there is any amendment here per se. It is just more of a clarification. And the last thing is, even in case of convertibles. Now, if I have to classify a convertible, even over here there is a clarification. It's not an amendment. If I have to classify a convertible, now as per your favorite Ind AS 32 and Ind AS 109, convertibles are split between liability and equity component. Now within equity there's no current and non-current classification, equity component. But when there's a liability component, there is a current and a non-current classification. Okay, fair enough. Now sometimes what might happen is, you might have a convertible bond where settlement is happening for a variable number of own equity instruments. If they are for a variable number of own equity instruments, they'll be classified as liability, not as equity. Now, if they're classified as liability, and let us say the conversion is going to happen in, let's say, 9 months. Now, you will say that the conversion is going to happen in 9 months, which means ideally it should be current. But we say current means you have to pay cash. Here, we are not going to pay cash. We are going to settle through our own shares, variable number of own shares, but our own shares. So there was a conflict that should I show it as current liability, non-current liability, because at the end, I'm not going to pay cash. I'm going to give my shares. Ind AS clarifies and they say that even if the settlement is going to happen in shares. Now, one may argue that if the settlement is happening in shares, it will be equity in nature. Yes, it will be if the settlement is for a fixed number of shares. But if it is for variable number of shares, it can be liability. And if it is liability, you have to show between current and non-current. So, merely because your settlement is happening in shares, you cannot say that it is not going to be shown in current. It will still be current if the settlement is likely to be in less than 12 months. So that is what they say. The liability component that is there, you will classify as current or non-current based on whether the settlement is happening in less than 12 months or more than 12 months. If it is happening in less than 12 months, even if the settlement is happening by issuing shares, it will be treated as a current liability. If it is beyond 12 months, it will be treated as non-current. So whether the settlement happens in cash or in shares, it does not matter. If it is within 12 months, it will be current. If it is beyond 12 months, it is non-current, provided it is classified as a liability. Mind you, if it is classified as an equity, within equity there is no current and non-current classification per se. Okay, so this is regarding the changes in Ind AS 1. Next, there are two other things which is for Ind AS 7 and Ind AS 12. Now Ind AS 12, over here we'll quickly review it once. This is something which is not relevant or important from either a tax paper or a FR paper, but globally there is now a concept of something called as two-pillar taxation. Now I'll just quickly brief you with what two-pillar taxation is, though you don't have to worry. Now you don't run to a tax paper and say that there's an amendment, there's nothing. Now there's something called as OECD, Organization of Economic Developed Countries or whatever something. So OECD has said that what a lot of large MNCs, usually large MNCs are those which are having more than 700 to 750 million euros of base. So if you are a large MNC, what was seen is these large MNCs would set up subsidiaries in certain low-cost jurisdictions, like you will have Cyprus, you will have Singapore, you will have Dubai, you will set up over there. And in US, for example, your tax rate is 35%. But let us say in these jurisdictions like Dubai, which is 5%, Singapore, which may be 10%, for example, you may be setting up companies and you may shift a lot of your profits over there, that even if they are subjected to tax, they are subject to tax at a much lower rate. And hence OECD came up with a concept of something called as a global minimum tax, which will be around 15%. So even if you are based in Dubai and you are a large MNC who has a subsidiary in Dubai, whose income is, let's say, taxed at the rate of 5%, there will be a top-up tax. What is top-up? Well, if the global minimum tax is 15% and you are only paying 5% tax on your Dubai-based income, you will have to pay another 10% tax as well. That is called as top-up tax. Is two-pillar taxation applicable everywhere? The answer is no. Every country has to decide whether they want to apply two-pillar taxation or not. India, for example, has not applied. Even if a country has decided to apply, there will be a conflict on which country will get the claim on that 10%. Will it be the host country, that is Dubai, or will it be the resident country, source country, whatever it is. So will it be US, will it be Dubai? So there is a lot of complexities still to be resolved in the two-pillar taxation. But what is a two-pillar taxation? Like in India, you have the concept of MAT. In a similar way, they are contemplating globally to have a global minimum tax so that the MNCs don't kind of siphon away their profit to low-cost jurisdictions. So they have to pay a minimum 15%. If they have paid 5%, then the top-up tax additionally, that is a two-pillar, that is a separate tax of 10% will have to be paid. Sir, but why are we discussing right now? Because in your FR, you have a chapter called as Ind AS 12, which is deferred tax. What is deferred tax? If there's a difference due to which you will have to pay more tax in the later years, that can create a deferred tax liability. So let us say, for example, there is a large MNC and it has a subsidiary in Dubai on which current tax of 5% has been paid. For the 10% top-up tax, do I need to create any deferred tax liability? The answer is no. As of now, IFRS, Ind AS, they are just observing and they are saying that across the world, very few jurisdictions have actually agreed for, let us say, this two-pillar taxation, and hence they have said that forget it. If, let us say, there's a two-pillar taxation, you will only record expense based on current tax which is there. For that second pillar, that is a top-up tax, you will not create any deferred tax asset or a deferred tax liability. Sir, before exam, what all are we listening? What will we do? So over here, from an exam perspective, just remember, in case it comes up, rarest of the rare chance, there will be no deferred tax asset or a liability created due to the application of a two-pillar taxation, though India does not even apply the two-pillar taxation. But if it does, there will be no additional DT or DTL that will be created. However, there will be certain disclosures which will still be given. That is, you will have to mention in the notes that I have taken this exception which is allowed under Ind AS 12 to not create a DTA or a DTL. So that exception disclosure will have to be given. Further, you will have to separately disclose the current tax. Let's say, for example, you are paying a 5% tax in Dubai, you will have to disclose that current tax irrespective, because that is something that you have to pay. And if, let's say, you have later ended up paying the top-up tax, then the top-up tax will be disclosed. as and when it is paid as a current tax. You will not create a deferred tax for that right now. And thirdly, the fact that you are having this exposure to a possible two-pillar taxation, that fact needs to be disclosed. So over here, simplistically, as per Ind AS 12, the amendment over here is, if let us say there is a large MNC where there is a possibility of a two-pillar tax application. Two-pillar means one is a tax that you have to pay on your income based on the local jurisdiction, plus let us say in order to have that global minimum tax of 15%, additional tax, top-up tax, what it is called, has to be paid. For that top-up tax, no separate DT or DTL has to be created. However, you will have to give a disclosure that you're not creating a DT or DTL because of this exception under Ind AS. You will have to mention the current tax that has been paid, and you will also have to see if you are exposed to certain changes due to this. And then you have the last case. This is a pure disclosure. This is absolutely pure disclosure. So if it comes, I'm pretty sure this will be in an IBS, not in a FR paper. Now, when you see Ind AS 7, this is a standalone cash flows. Now, on this, there is a separate arrangement that they've discussed, which is called as a supplier finance arrangement. Now, what do you mean by supplier finance arrangement? Like, this is the reverse of the factoring arrangement. Now, in factoring, what happens if an entity has debtors and it wants money quickly, it goes to a factor. Now, here what happens is, let us say you are, let us say, purchasing goods. So there is a supplier who is demanding payment. Now, as per the normal terms, the payment is to be made in 30 days. Now, the supplier is pushing you to make this payment in 5 days. Now, you don't have money to make it in 5 days. In fact, you are thinking that I want a 90-day period. So here you are in a possibility where the supplier can stop supplying goods to you. In such a case, an NBFC steps in. Let's say a finance company steps in. They say that you have to pay, let's say, 1 lakh rupees after 30 days. These guys want money, let us say 1,95,000. They are okay taking, let's say, a lower amount as well as a cash discount, but you need working capital to pay. So this supplier needs money. In a supplier finance arrangement, the NBFC says that on your behalf, I will pay off the supplier. So if you had to pay 1 lakh rupees, whatever is the agreed amount, I will pay off to the supplier, let us say within 5 days. Okay. Which means your liability is extinguished? No, but you will have to pay. Earlier you had to pay the supplier. Now, instead of you paying to the supplier, you will have to pay the NBFC. But you say, okay, if Mr. NBFC, you give me some time, you pay me after 90 days. NBFC says, I'll charge you interest. We say, okay, that is not a problem. You charge some interest, but I'll make you a payment after 90 days. Which means what happens is your regular trade payable arrangement now gets converted into a financing, that is a loan arrangement. So when you are preparing a cash flow statement, a financing cash flow goes into cash flow from financing. A trade payable payment, let us say, goes into cash flow from operating. So over here, when we are looking at this supplier finance arrangement, we would say that when, let us say, we have an obligation to pay. Now, instead of we paying, the NBFC is paying off the supplier, in which case the trade payable is paid off. However, I have a payable to whom? Well, to the NBFC. This will be a financing activity. Now, if such a thing is happening, I will have to show the disclosure for the supplier financing arrangements in terms of what are the terms and conditions of these arrangements, like what is the rate of interest, what is the time period. If there are certain dissimilar terms, you'll have to show that those dissimilar terms. It is just about disclosure. If, let us say, you have entered into such arrangements, you'll have to show the carrying amount and the associated, the affected line items in your financial statements which are impacted by the supplier financing arrangements. You also, if during the year, let us say on 31st March, there are certain suppliers who have actually been paid, but NBFC payable is still remaining, like for let us say the goods that you have purchased in March, the NBFC has paid. However, you are going to pay the NBFC in 1 or 2 months. So you'll have to give a disclosure that, okay, out of these arrangements, how much has been paid, how much is yet to be paid to whom. You'll have to give the range of the dates. Like, for example, in this financing arrangements, 90 days, 60 days, what time you are getting to make the payment, that range of payment will have to be mentioned, and you will compare it with, let us say, payment that you are doing under the normal terms. Like in the normal terms, the creditors are giving you 30 days average time frame, and in supplier financing you are taking 90 days. So you give the disclosure that, okay, the normal terms I would have paid it in 30 days. However, here under the supplier financing arrangement, I'm paying it in 90 days. So over here, when you look at a supplier financing arrangement, this can also be called as a reverse factoring arrangement. It is essentially disclosure. Nothing at all changes. Disclosure in terms of terms and conditions of the supplier financing arrangement, the carrying amounts of the liabilities, associated line items of supplier finance, including the amounts paid, range of due dates, etc. It's a very specific and special case, for which a lot of accounting has not been discussed by the institute further. Though the accounting we are saying is when the trade payable is settled, it is like an operating cash flow, whereas when the supplier finance amount is paid, when you pay to the NBFC, it is more like a financing cash flow. And if there is some non-cash changes, maybe during the year you have done some business combination due to which you have acquired some other company's supplier finance arrangements, so all of that has to be disclosed. So that, if you can call, is an amendment. Over here they kind of clarify that what is the supplier financing arrangement. You paying your credit card dues, or you paying under, let us say, letter of credit, is not a supplier finance. Over here credit card payment is your payment only. Basically when you have swiped, let us say, it is you who are supposed to pay, but after a particular number of days, as per, that is not supplier finance. Supplier finance means the supplier to the supplier, let us say NBFC is paying, and then after a set number of days you are paying to the NBFC, which is, let us say, subjected to certain interest. Over here the only changes over here will be in terms of disclosures. So this takes care of the amendment. So around 40 odd minutes we have covered all the amendments. I'll share these notes as well in your Telegram channel so that it is easier for you to access. Now when you read this, I am saying that you don't currently need to read this. If you understand what I've said broadly, that is more than sufficient. From an accounting standpoint, there is zero changes in any of the sums, in any of them. If for example you are giving the May or the September 26 paper, at least, even if you are giving the May 27 onwards paper, there will be a change in a question for Ind AS 1, for which we have given reference to that separate specific video, but I'm not discussing it right now, not to confuse, let us say, students who have their exams immediately. But otherwise all of these are things which are new, and if you keep on reading this, there is a lot of literature, and reading 13-14 completely new pages will appear to be very, very daunting. So I would say that keep them handy. In case for IBS, if something like this comes, you know what to look at, but you don't at all need to read all of these, as long as you are broadly clear in these 40 minutes, which also you might have heard at probably 1.5 or 2x. Okay, so next we will go on into the questions. The first case study is a very similar case study to a question which is there, I think question 49 or 50 on Ind AS 115 on customer loyalty points and discount vouchers. So you can just review this. It's quite similar. There's question number 6, which is on consolidation, which is similar to the aqua bacca question, where you are preparing at a different date, you are making adjustments, and then you are doing consolidation. So you can just review that as well. Question number 7 is again very similar to a question where you have to identify a particular item going into PNL or OCI being reclassifiable, non-reclassifiable. You can quickly review it. Nothing new over here. Okay, so what are the new questions? As we said, new meaning in this RTP, you don't have very different numerical questions. They appear to be slightly different as compared to what you would have seen, but these questions are largely based on concepts which you can solve. If you see the printed solution in the RTP, well, they have given you truckloads and truckloads of theory. You don't have to go into so much of theory. As long as you are able to solve numerically and understand what is asked, I think you are in a good position. So let us go to question number 8. X Limited has two wholly owned subsidiaries, A and B. The company has acquired 100% equity of these companies at 1st April 2021. And the investment was made as under on 1st April. You had this balance, and then profit or loss for the year. Each of these years, you can see for A, there is a loss which is coming. Now, if you are preparing consolidated financial statements, there will be certain net assets. That is, you started at 5 lakhs, must be investment, but that will be represented by net assets and then the goodwill of the subsidiary in the CFS. Now, every year there is a loss, which means that loss will keep on reducing the net assets and your consolidated loss will be getting affected. And for B, there are profits. So if I go to C, in the CFS, there will be 5 lakhs minus what, 50, 60, 70. So this comes to maybe 3,20,000 of, let us say, carrying value of net assets in the CFS. In consolidated financial statements, you will eliminate the investment. Instead, on the date of acquisition, bring in the net assets, bring in the goodwill. So that will be, let us say something, let's say net assets account debit, goodwill account debit, I don't know how much, to let us say investment. This investment will be eliminated to the extent of 500, and in return net assets and goodwill will be recorded. As every year there is loss, these net assets will keep on reducing, and maybe this will become around 3,20,000 at 31st March 20x4. Achha, when you look at B, this is 5 lakhs plus 50 plus 60 plus 70. This is around 6,80,000. Over here, your profits will increase. Let us say the net asset exposure. Okay, on 31st March 20x4, which is around 3 years later, in the standalone finance statements of X, the future projections of company A being negative, the entire investment was impaired by 5 lakhs. So in your standalone books, the carrying value becomes 0. The same was disallowed under income tax laws of X jurisdiction. Income tax does not allow recognizing impairment. Further, in the consolidated finance statements of X, the net assets in relation to A were also fully impaired. So whatever are the net assets, they were fully impaired. So your carrying value is no longer 3,20,000. I would in my CFS have recorded 3,20,000 worth of net assets. They are fully impaired. So whether income tax allows or not, as per Ind AS 36, I will write them off and their value will become 0. So as per Ind AS, the carrying value is 0. This is for A. Next, this is for B. As on 31st March 20x4, B has an excess earning available which would be transferred to the holding company in the future. So B has some earnings. We expect to distribute them to the parent in the future, but it cannot be repatriated in a tax-free manner. Okay, so when, let us say, you give, repatriate or distribute it as dividend, there will be certain tax which will be applicable. That is fine. You are required on preparation of the CFS. So they are only asking you for consolidated financial statements. Would a deferred tax liability be recorded for the difference in the carrying value and the tax books for A in the CFS of X? Assume no indexation benefit is available for investment. So the same thing is asked for B. Would a deferred tax liability for difference in the carrying value and tax books for B in the CFS of B? Assume no indexation benefit available for B. Now if I were to look at, for example, question number, I think, what is this? I think question number 8, which is there. I will look at my investment. If I look at CFS, in the CFS, you will have, let us say, the net assets or investment as a case maybe for A, for B. Now, if I calculate the carrying value is the value as per Ind AS. The carrying value for A would be nil after incorporating. So earlier it was 3,20,000. Now after you write off, sir, but impairment is disallowed. That is disallowed in income tax. In books it will still be there, so this will be nil. Second, you will compare this with the tax base. Tax base is the amount appearing in the tax balance sheet. In income tax does not recognize consolidation. So in income tax, I will still have, let us say, an investment of 5 lakhs. That is still appearing. So is there a difference? The answer is yes, sir. But how is this difference temporary? This difference is temporary because when, let us say, this investment is liquidated, sold, etc., let us say I get 0 rupees. In my books, there will be no further entry. But in income tax, your entry is, let's say, bank account debit 0, loss account debit 5 lakhs, to investment 5 lakhs. In which case, you will get a deduction in the future years. And if there's a deduction in the future years, you will create a deferred tax asset. So over here, you will create what is called as a DTA. For deferred tax, you will create a DTS 5 lakhs into whatever is the tax rate. I think the tax rate is not given, so on this you will create a DTA. But remember, you can only create a DTA if you expect sufficient profits to be earned against which you can utilize these losses, and you believe that these losses will be availed and utilized. Only then, subject to certain conditions, you can create a DTA. So subject to these conditions, a DTA will be created. Okay, on the other hand, when you look at company B, let us say the carrying value over here is 6,80,000. If I still look at the tax base over here, income tax does not recognize, I mean, it will show the investment at cost only. There are a couple of questions that we have done also, I think question 17 or 18 on similar lines. So there will be a difference of 1,80,000. Now the question arises, is this difference temporary? We will say yes, because for this difference in the books of accounts you have recorded a profit. However, in income tax, this in CFS you have recorded a profit of 1,80,000 over the 3 years, but in income tax you did not recognize it. You will recognize it the moment, let us say this investment is sold at 6,80,000. Your entry will be bank account debit 6,80,000 to investment 5 lakhs to gain 1,80,000 in income tax records. In your CFS, in SFS, whatever is there, we are not looking at it. We are looking at CFS. In CFS, your net assets are 6 lakh 80. So if you sell it at 6 lakh 80, your entry will be bank account debit 6 lakh 80 to net asset 6 lakh 80, in which case there will be no further gain or loss in the CFS. However, in income tax, there will be a 1 lakh 80,000 gain, on which, for example, there would be, let us say, tax. This can arise at the time of sale, or this can also arise at the time of distribution when you repatriate the funds, and the question very clearly tells you that it is likely that you will repatriate these funds in the future, and when you repatriate, the parent will receive and there will be a tax. So over here on this 1 lakh 80, this is a situation where if you go to see, your carrying value is greater than tax base. So mechanically your answer over here is opposite. Conceptually you can always say that, well, over here for this 1 lakh 80, when I receive, I will have to pay tax. So I have to pay tax in the future. So that will give me a deferred tax liability. So this will create a DTL at the rate when I repatriate, whatever is the repatriation tax percentage, on that I will create a deferred tax liability. Remember, there is an exception over here. The exception over here is you are allowed not to create a DTL for investments in subsidiary, provided you believe that you control the timing of distribution, which you do, and you believe that the distribution will not happen in the foreseeable future. In this particular case, it is very clearly given over here that these excess earnings would be transferred to the holding company in the future. How many? We don't know. So let us assume the entire 1 lakh 80 will be transferred in the foreseeable future, and as and when they are transferred, there will be some deferred tax consequences, and hence you will create a deferred tax. So over here there will be a DTA that will be created. Over here there will be a DTL that will be created. Tax rate is not given in the question, so we cannot do the calculation for the same. Okay, so this is a slightly different question. You can just review it. Borrowing cost question is a similar question to the group borrowing cost, where let us say we have done, I think, a big question number 17 on similar lines. This is there. Then we have an intangible question, which is also in a way similar, but there are certain few different adjustments. We'll quickly review this. They are asking you what costs can be capitalized. A has incurred 1 lakh of research expenditure in a project to develop a new type of fuel, and his expense is cost. So in the books of A, there is no intangible asset. B purchases the research project, including certain patents which have been registered by A, for 1 lakh 50. So this is in process R&D that B is acquiring, and this is a separately identifiable asset. I'm acquiring only that, and hence I can recognize the intangible in process R&D at 1 lakh 50, and recognizes an intangible asset. We have studied that in process R&D can be recorded. Over here it's a separately identifiable asset for B. B is actually paying 1 lakh 50,000 for it, and hence it can be recorded. But subsequently B incurs 2 lakhs expenditure on completing the research phase. Now for B, now this 2 lakhs is for the research. This has to go to the P&L account, and decides to develop the product commercially, for which it incurs another 3 lakhs of cost to bring the product to a stage where the conditions for recognizing the development cost of an internally generated intangibles are met. So even this 3 lakhs will be transferred to the P&L account, because they are still incurred to get the intangible into a condition to move into the development phase. After this 3 lakh is incurred, maybe you are going into the development phase. Then later further cost of 1 million are incurred in bringing the product into a condition where it is ready for use in the manner that the management intends. So this is a development cost. 1 million is 10 lakhs. So this will be capitalized. Marketing and other initial losses of 2 lakhs are incurred before the product reaches widespread distribution. This will go to the P&L account. This is, so this 2 lakh and this 3 lakh can be said to be research cost. This 2 lakh over here is like the marketing cost. But if I were to figure out what is the cost to be capitalized, I'll say that is 11 lakh 50,000 of your overall cost that will be capitalized. That is about it. Okay, this is question number 10. Then we have question number 11. Usually financial instrument is a scary adjustment. Over here it is not as much. We'll just review it quickly. On 1st of April in a particular year, ZX originates a 10-year 6% loan. So over here it is originating, which is interpreted to be it is giving a loan. This is what the interpretation is. Originating means you are giving a loan, at least in the context of this question. The loan carries an annual interest rate of 6% payable at the end of each year, and the loan is repayable at par at the end of year 10. So it's a 10-year loan, repayable at par. ZX charges you, this is a different thing. ZX charges 3,000 non-refundable loan original fee to the borrower. So this context gives you, someone usually argues that originates means am I giving the loan or taking the loan. It is debatable, but here it is clearly said that ZX charges 3,000 non-refundable loan origination fee to the borrower. So ZX is like lending, and from the borrower it is charging some 3,000 amount. This is something which is not usually there in most of your financial instrument questions, and it also incurs 5,000 direct loan origination cost. So when I look at ZX over here, for ZX, this loan given is a financial asset. So if I look at, for example, question number 11, when I look at question number 11, when I look at ZX, for ZX, if this is a loan given, this is a financial asset. Ideally, this financial asset will be recorded using amortized cost principles unless you are planning to sell this loan. Otherwise, it is financial principle, amortized cost principles, and this loan is at market. Now, there may be certain transaction cost here or there. However, other than pure lending and borrowing, there does not appear to be anything over here. In which case, initially, your fair value is equal to your transaction price, which is equal to 1 lakh. And hence, initially, ideally, your entry at year 0 will be loan account debit. You will give a loan account debit 1 lakh to, let us say, bank. Loan account debit to bank, let us say 1 lakh. Now you are recovering, you are getting 3,000 at year 0. Your entry is bank account debit 3,000. So in a way, your net money that you have lent reduces to loan. This is 3,000. So your net loan becomes 97,000. But so is this transaction cost? No, transaction cost is what you are paying, like the 5,000 that you pay, that will be added. So loan account debit 5,000 direct origination fee to bank. Usually you pay the transaction cost. In this case, you are recovering 3,000, and therefore your loan balance initially will be 1 lakh minus 3 plus 5, and hence it is 1 lakh 2,000. And I will prepare an amortization table over 10 years for that 1 lakh 2,000, and it will slowly come down to, let us say, 1 lakh. The contract specifies that the borrower has an option to prepay the instrument and no penalty will be charged on prepayment. That is fine. So there's a prepayment option. The contract meets the SPPI criteria, which means it is solely payment of principal and interest on principal payment outstanding. At inception, ZX expects the borrower not to prepay. Okay, that's fine, which means you will prepare the table for the entire 10 years. One can always argue that, sir, what if there is an embedded derivative for prepayment? You don't have enough data to separate it. You need to find the value loan had there be no prepayment option. All of that data is not given, so you will avoid doing any of that. Sir, to strike ही नहीं हुआ. The effective interest rate is approximately 5.7317%. What is the carrying amount at initial recognition? That is 1 lakh 2. And what is the impact does prepayment feature have on the amortized cost calculation? No impact, because I'm not expecting a prepayment, and hence I will do the working for the entire year. So if I had to do the working, your opening loan will be 1 lakh 2,000, on which there will be an effective interest rate at the rate of 5.37, whatever this number is, 5.7317%, 5.7317%. There will be a coupon payment at 6% of 1 lakh, that is 6,000, and thereby you will get a closing. So over here, this is 1 lakh 2,000 into 5.7317%, which comes to around 5,846, and hence there's a difference of around 100 and something, which is more like an amortization. 1 lakh 2,000 plus 5,846 minus 6,000, and you get 1 lakh 1,846. And if you keep on doing this for 10 years, you will see this given behind. If you keep on doing this, for example, for the 10 years, you start at 1 lakh 2,000, it is 1 lakh 1,846. For 10 years, it will come down to 1 lakh rupees. You can make this table. Nothing over here. The important part over here is this calculation. In my understanding, this charge to the borrower is not usually done. Usually when you are giving the loan, you are only paying, which you are 5,000, but here you are also recovering, and that only the net amount is taken, which is slightly different over here. So that is question number 11. Next you go to question number, I think, 12. This is on revenue. This is on, let's say, performance obligations being distinct or not distinct. So over here, when you look at distinct, When are they distinct? Well, if the buyer gets the benefit and they are in a way separately identifiable, that is, they are not a part of a larger single integration exercise, not highly customization, modification, not highly interrelated, that is when they are distinct. Again, even if they are distinct, like when I'm selling newspapers annually, every day, the newspaper I give on day 1 is distinct from day 2, is distinct from newspaper on day 3. However, there is a series of performance obligation condition where if all of them are have a similar pattern of transfer, then that can be taken as a series of performance obligation, which is treated as a single performance obligation. So this is kind of discussed over here. X Limited agrees to produce 2000 customized engines for use by customer A in its products. X concludes that the engines will be transferred to customer A over time because they have no alternative use to X. Okay. And A is contractually obliged to pay X for any finished or in-process engines, including a reasonable margin, if the customer A terminates the contract, even if there is no fault of X. So remember, there are two conditions for over the time recognition, among other things. If, let us say, the product that you are selling has no alternative use to the seller and you are entitled to get compensation based on work done plus a reasonable profit margin, then you can recognize revenue based on, let us say, overtime recognition, which is the case over here. X already has the process in place to produce the engines and is given the design by customer A such that X does not expect to incur any significant learning curve or design and development costs. That is fine, it is not significant here. X uses a method of measuring progress towards the complete satisfaction of manufacturing contracts that takes into account the work in progress and finished goods controlled by customer A. So they are just saying that some method is used to measure progress because it is overtime recognition, in which case you have to use a method to measure progress. They are not mentioning anything else. Required to state whether 2000 engines are distinct in nature or not. Are these 2000 engines a part of a significant integration exercise? No. Are they highly customizing or modifying anything? No. Are they highly interrelated? No. And hence I will say, are these 2000 engines distinct? The answer is yes, they are distinct. Each of these 2000 engines are distinct from each other. Like each of the newspaper on day 1 is distinct from newspaper on day 2. Second, state whether the 2000 engines is a single performance obligation or each engine is a separate performance obligation. We will say that because the pattern of transfer for each of these engines is similar, this can be a series of distinct performance obligations. If it's a series of distinct performance obligations which have the same pattern of transfer, as per Ind AS 115, they are taken as a single overall performance obligation, which is the case over here. So it's more of a theory case based discussion. Question number 12. Next you go to question number 13 over here. A Limited has acquired an equipment for 10 lakhs, 100 lakhs. The estimated useful life of the equipment is 10 years and the residual value is nil. Depreciation is recorded on SLM. So if nothing is there, depreciation is 10. To encourage acquisition of the assets, very clearly given. The government will give a grant to A towards the purchase of the equipment as follows. Government will give a grant. Okay, I don't know whether it is given or not. If the specified employment targets are achieved by the end of the third year, A will receive a grant of 10 lakhs. In all other cases, A will receive a grant of 5 lakhs. Now, this is a little tricky. This part we have not done. We have usually said that when do you recognize a grant? We will recognize a grant initially if the conditions are if, let us say, the moment a grant becomes receivable, usually when you buy the machine, one can say that you have fulfilled and hence a grant becomes receivable. You don't need to wait till the time conditions are actually complied. At least for Ind AS 20, you can recognize a grant based on you estimating to complete those conditions. And if you don't comply, then let us say there may be a refund of the grant. Okay, on the date of acquisition as well as at the end of year 1, A expects to receive a grant of 10 lakhs. Okay, so basically what would have happened is, if I were to look at question number 13, I would have bought the PP. After that, maybe I have not yet received the money, but initial recognition of grant can happen because this is for the purpose of acquisition of PP. So your entry will be PP account debit, let us say 100, to let us say bank, for example 100. Acha, then grant has not yet been received, but you can still recognize it as a grant receivable. So there will be a grant receivable account debit you don't need to wait till the time conditions are fulfilled. You can still recognize it if you estimate that the conditions will be fulfilled under Ind AS 20. So receivable account debit 10 lakhs because we estimate that those conditions will be fulfilled. At the beginning of year 2, A has revised the assessment in light of the development and now expects it will only receive a grant of 5 lakhs. Now the way they have solved, I think they have solved considering the end of year 2, and hence I think there will be a small change over here considering end to just tie up with the institute solution. But let us say receive a grant of only 5 lakhs. There were no errors in the estimate of grants in the prior period. A has assessed and concluded the grant is in the nature of grant relating to assets. So even if this was not given at the beginning, they have said that this grant is for the acquisition of an asset, to encourage acquisition of asset. So this is grant in the form of assets. Okay. A presents the grant linked to assets can either be reduced from the cost, or let us say they can be taken as deferred grants. A presents the government grants relating to assets in the balance sheet by deducting the grant in calculating the carrying amount of the assets. So over here, your entry would have been grant receivable account debit to PP. I would have reduced this by 10, and therefore my net PP would appear at what? My net PP would appear at year 0 at, for example, 90, on which if I charge the depreciation of year 1 will be, for example, 9. So this comes to 81. In line with institute solution, they have changed the estimate at the end of the second year. So if I keep it in a similar way, then at the end of the second year, another 9, and hence this will come to 72. This will be the WDV of the machine at the end of the second year. Now the problem is, now I believe that only 5 lakhs will be received. I have still shown a receivable of 10 lakhs. I'll have to make an adjusting entry. So over here, there will be an adjusting entry. I will have to reduce my receivable. To receivable, I will have to reduce 10 minus 5. That is why if I had received, then I'll have to refund. That is to bank, I'll have to have 5. But where will this go? Well, this will go where the grant had originally gone. Where did the entire grant originally go? So the entire 10 rupees went to the PP. So if this is similar to refund, that is you're not receiving, like a cash outflow, cash inflow avoided is similar to cash outflow. Like refund is a cash outflow of 5. Here you're not actually paying 5. However, the fact that you're receiving 5 less, that is like a cash outflow. Cash inflow avoided is similar to cash outflow. That is how they have solved. And in my opinion, that is correct. Now the problem is, what will you debit? Sir, the answer would be ideally PP will be debited. But sir, will the PP be debited by the entire amount? The answer is no. The law says that you will adjust over here the impact of the depreciation. Had there been no such situation, your PP would still be 100. The grant would be 5 rupees, not 10 rupees, in which case your PP initially, had there been no such condition, would have been 95. Now on 95, the depreciation would have been 9.5, which means this comes to what? 95 minus 9.5 comes to 85.5, another 9.5, and this comes to 76, which means had there been no such situation, your PP would be 76 instead of 72. So your PP will be increased by 4. Sir, but what about this difference? Well, there would be additional depreciation. As you can see over here, there would be a further 0.5 and 0.5, that is 1 depreciation. So this will go to the P&L on account of the additional depreciation, which should be recorded as per Ind AS 20 of 1 rupee. So over here, at the time of refund, we would not refund, basically change in this assessment. We will credit the bank if it has to be paid, or grant receivable if it is yet to be received by 5. The corresponding effect would go where the grant had originally gone. The grant was linked to assets and it had originally gone to the asset, and hence you will reverse it against the asset. But while reversing this, you have to ensure that you also take the impact of the cumulative depreciation, that is 0.5 for 2 years, that is 1 rupee. Additionally, I will push that into the profit and loss account, and the remaining 4 will be adjusted against PP. So that takes care of question number 13. Next you go to question number 14. Now this is on leases, and when you look at lease, let us review this. The lessee enters into an agreement with the lessor. This is separation of lease and non-lease component, and you allocate the lease in the ratio of the standalone selling price. That's about it. lessee enters into an agreement with the lessor for a period of 5 years to lease a floor of a building. Lessee is required to make a fixed annual payment of 4,20,000, that is total payment of 21 lakhs over a 5-year period. As per the terms of the contract, 4,20,000 comprises of, so there is a building rent, okay, this common area maintenance, this is a non-lease component, building is a lease component, property taxes and building insurance, these are neither lease nor non-lease. Remember, against building rent you are getting, let us say, a right to use the building. Against common area maintenance you will get cleaning etc done, but taxes are obligation of the landlord. Insurance benefit comes to the landlord, and as a result these are neither lease nor they are non-lease components. However, you have a total of 4,20,000 that is being paid. From the lessee's perspective, the estimated standalone price of the building rent is 264 and the standalone price of the common area maintenance is 96,000. Okay, so this is standalone price. Ind AS 116 says you will allocate the lease payments in the ratio of the standalone price. Lessee has not elected to apply the practical expedient, that is shortcut, of not separating the non-lease components from the lease components. So they have not selected that shortcut, which means they will separate. Hence, it has to separate the non-lease component from the lease components. How will the above payments be allocated and accounted by the lessee? Well, they will be allocated in the ratio of standalone price. Sir, payments would be what? 4,20,000, that is my total payment, allocated in the ratio of the standalone price. Well, to the building I will allocate, that is the lease component, I will allocate 264 upon 264 plus 96, that is 360. This approximately come to 3,08,000. What they have done is 73.33%, and hence they have got a small rounding of difference, but this is more accurate. And to the maintenance, which is the non-lease component, this is 4,20,000 into 96 divided by, for example, this is 96 upon 264 by 96, and hence whatever is the difference over here, I believe this is 1,12,000 will be attributable to maintenance. How will the above payments be allocated by the lessee? Well, they will be allocated in the ratio of the standalone price, and that's about it. Actually, question 15 is very similar to a question which is already there in terms of interest for a zero coupon bond or a bond which has effective interest method. So where will they be shown? It's very similar. And then you have the last question. This is pertaining to what is called as onerous or burdensome contract. So they are asking you whether a contract is onerous or not. Remember, if a contract is usually said to be onerous if, let us say, the cost of fulfilling the contract is greater than the benefits that you will get out of the contract. And usually the onerous element, the burdensome element, you have to create a provision for losses. If the contract is onerous, the provision will be created at an amount which is lower of the price the loss if I were to fulfill the contract, or the loss if I were to exit the contract, in which case whatever is lower will be my loss. So this is the last question of the RTP. We'll quickly review this. An entity has a contract to purchase 1 million units of gas at 23 paise. That is a purchase price, giving a price of 2,30,000. The current market price of a similar contract is 16 paise. Okay, giving a price of 1,60,000. The gas is used to generate electricity, which will be sold at a profit. Now, I don't intend to sell it to someone else. I intend to use this gas to make electricity, and I will sell this electricity at a profit, in which case the gas that I'm buying, this contract is not onerous. Let the price over here fall of the gas from 23 paise to 16 paise. I am going to use it to make electricity, which is going to be sold at a profit, and hence is this contract onerous? The answer is no. Second, again the first few lines are same. Contract to purchase 1 million units at 23 paise, 2,30,000, current price for similar 16 paise, that is 1,60,000, that is fine. But the gas will be used to generate electricity. However, the electricity is sold at a loss and the entity makes an overall operating loss. All of the gas purchased by the entity is used to generate electricity using dedicated assets. So Ind AS 37 says that this showcases an indicator of impairment first. Like, you are making electricity using this gas. This electricity is sold at a loss, and hence these assets are likely to not generate sufficient value in use. So you will check these assets for impairment. The electricity is sold to a wide range of customers. So first of all, you will check these assets for impairment. If there is any impairment, you will recognize impairment. And then if, let us say, beyond that, if there is any further loss, then this contract can also be considered as onerous and be accounted accordingly. In this case, you don't have enough data to find the recoverable value, and hence impairment and other calculations are not possible. Okay, next, an entity has a contract to purchase same 1 million units at 23 paise, giving a contract price of 2,30,000. Current price for similar contracts is 16 paise, 1,60,000. The gas will be used to generate electricity. However, entity sells the gas, which it no longer needs, to a third party at 18 paise. Okay, that is 5 paise below the cost. The entity determines that it will have to pay 55,000 to exit the contract. State whether the contract is onerous. If the contract is onerous, also state the amount of provision to be made on account of the onerous contract. Now, over here, I can either buy this gas and sell it somewhere else and generate maybe 18 paise. See, I have not been told that the electricity will be produced and be sold at a profit or not, so I can't comment on that. But I can at least say that the gas that is purchased will be sold. Let us say this will be sold at 18 paise, so there will be a 5 paise loss. So if I were to fulfill this contract, there will be a loss of 5 paise into 1 million, and hence there will be a 50,000 loss. Alternatively, I can exit this contract, in which case there will be a 55,000 loss. What will I prefer? Well, I will prefer to at least buy and then sell it and at least make a 50,000 loss rather than a 55,000 loss. So my unavoidable loss, I can say, is 50,000. So this contract is definitely onerous, and if it is onerous, I will create a provision for 50,000 for the onerous, that is a burdensome element. In the year 31st March 20X1, an entity has a contract with a third party supplier. The entity wishes to terminate this contract in, this is a different case now. In the year 20X1, entity has a contract with the third party supplier. The entity wishes to terminate this contract in the year 21-22. Okay, next year. Even though it will still have 2 years to run, because it can enter into a cheaper contract with the new supplier. And it will incur a charge for terminating the contract. Okay, this will happen in the year 21-22. Does the entity have to provide for this loss in the year 2021 for the contract that it will be exiting in the year 21-22? The answer is no. Remember, I will have to provide if, let us say, I have exited in the year 2021. I have not. I believe that in the next year, maybe I will exit. You are not doing accounting based on those probabilities. Over here, if you have not yet exited it, I cannot record something like an exit penalty for that, and as a result I will not record any further loss pertaining to this. So this kind of takes care of the RTP. So there's not a lot over here. You can just quickly review this, and I hope in this session of around 75 minutes we have tried to cover everything pertaining to this RTP. Other questions also you can review which are similar to questions which are already there. Even these questions, to some extent, concepts are similar, but it is always helpful if you have done it once, so that if a similar question comes, you're not wasting time in reading and understanding. You can just go into it much more faster. Okay, so that is it about FR. For AFM, we will have a separate video. Till then, study well, study hard, keep working. God bless you all and take care. Good luck.